Hi, Larissa. Also from my side, a very warm welcome to all of you. Happy to be here today. I would like to present you today my topic ESG reporting with SAP software, efficient solutions for emerging legal reporting requirements for sustainable businesses. Before we start, please allow me that I introduce myself. My name is Rainer Bieler. I'm responsible for business and IT transformation programs. Since 2018, my additional focus lays on ESG in general and ESG and regulations in particular. That is a topic across all industries. I took over the role of a Chief Sustainability Architect located in SAP Services, so I'm in consulting. And in this role, I'm acting as an interface between ESG legislation and customer needs on one hand side and the SAP product development on the other. My topic today is I would like to explain you what is behind ESG. It's a huge and a complex topic. What is behind of ESG in general? What are our answers as SAP on that? And how we as SAP address in particular the topic of sustainable finance. To do so, this is my agenda for today. First, I would like to explain to you the different meanings of ESG and why sustainable finance is key there. Then I'm going to explain our SAP solution concept, our modular structure, to meet all these very complicated ESG requirements. And in the last chapter, I'm going to present to you our solution with the aim to explain how this solution addresses the requirements of sustainable finance, which is the legal ESG reporting. Having said that, let me start with my first agenda topic. I will explain in this chapter how we as SAP services categorize ESG from a software provider perspective. I'm going to explain what is behind an ESRS disclosure requirement and what is behind of an ESRS KPI. I'm doing that because this helps to understand what is the real requirement when we talk about sustainable finance. And last but not least, I would like to explain in this chapter why sustainable finance is so central to the broader ESG discussion. Okay, let's start. We must make us clear who is the owner of ESG. The owner of ESG are the United Nations. The United Nations adopted 17 sustainability goals, 5 environmental goals, and the most important goal within the 17 sustainability goals is goal 13, climate action. And all the goals were adopted in 2015 by the United Nations as part of the United Nations 2030 agenda. Aim of the agenda is that based on the goals, the world would like to end poverty, protect the planet, and ensure prosperity for all the human mankind. So this is really important to mention because these goals have no legislatively character because the United Nations has no legal power. And this is the reason why countries now around the world are now implementing these goals at different speeds. And what we as SAP can observe that we can categorize the speeds around the world in 3 different dimensions, depending on the political balance of power in a specific region or in a specific country, we can observe 3 types of implementation worldwide. The first type is voluntarily ESG compliant behavior. Customers are asking us to help them to become ESG compliant because they want to be ESG compliant. First, we have a lot of corporate customers. They have a business model, and based on this business model, they can earn money with ESG. Think about the e-manufacturer. Think about the wind park industry, the solar industry, the battery industry, the waste industry, the circular economy industry. A lot of customers are asking us to support their business models with regard to ESG because they earn money with ESG. The second topic which is worth to mention is that ESG shapes the brand. In particular, young talents like to work for ESG compliant customers. And the third category here, which is worth to mention, is that a lot of our customers are asking us, please help us in our decarbonization strategy, because renewable energy is cheaper than fossil fuels, and it is easier to get renewable energy based on wind or solar panels than to export it from regions in the world where we have war. So this is voluntary ESG compliant behavior. We have to support our customers on that. The second category here is that we observe that in the last years, government tries to intervene direct in business processes with regard to ESG. Very prominent in Europe is bans, the combustion ban starting from 2035 on. A second topic where the government is doing direct intervention in business processes are CO2 prices and CO2 taxes, so that CO2 becomes part of the European emission trading system. For example, the CO2 price for climate damaging fuels was increased from 45 euros to 55 euros in January this year, and this means that the CO2 tax for a liter of gasoline increases as well by around 5 cents per liter gasoline. So this is a direct intervention in business processes driven by governments based on prices. And from 2027 on, the EU will include buildings and road transports in its CO2 emission trading system. So then full retailers, they have to buy the corresponding CO2 certificates, and this in turn will make heating in buildings using fossil fuels significantly more expensive. This is a pretty nice example how governments try to intervene direct in business processes to achieve transformation in behavior. And last but not least here, we have reporting and fees. So we have reporting requirements like the CS3D, in German, Lieferketten-Sorgfaltspflichtengesetz, or the CBAM or the EUDR. These are all reporting requirements, and it is not forbidden to act against this regulation, against these reporting requirements, but you have to pay a fee if you act against the regulation here. So this is also direct intervention in a corporate's customer's business processes. Based on reporting, it is identified, and then you have a fee. Last but not least, and this is for me the most prominent ESG topic, is ESG reporting. And the other term for ESG reporting is sustainable finance. In Europe, beginning with this year, many corporate customers are forced to report against the so-called ESRS standards, the Environmental Sustainability Reporting Standards. I will go in more detail on the next slide what is behind the ESRS, what does a disclosure requirement really means. But this is the main topic. You as a customer are forced at present that you have to establish a sustainable finance reporting within your company according to the ESRS requirements. And the second topic in Europe that you have to follow on is the EU taxonomy. Both requirements are part of legally required ESG reporting, which is in other words sustainable finance. But also other parts in the world adopted disclosure requirements with regard to, say, sustainability. The IFRS adopted the so-called ISSB standards, also standards to report your climate position in your company, and the US SEC adopted 4 years ago the climate-related disclosure requirements. So not only Europe is doing regulatory ESG reporting, also other parts in the world are heavily involved in the creation of regulation to make more transparent how ESG compliant a corporate customer really is. So let me summarize that. Voluntarily ESG compliant behavior we have to support as SAP, government intervention business processes. We have to support our customers on that. And for me and personally, the most prominent, most important topic that came up in the last years is the ESG reporting, the legally required ESG reporting, and the other term for that is sustainable finance. Now let me go a bit deeper, because in order to understand why we design our solutions, as we design our solution, it is good to understand what is behind the ESRS disclosure requirement. On the right-hand side, this is E1. This is the paper for climate change. And in this paper, or let me go back one step back. In total, we have 13 papers, and related to environment, we have 4 papers. E1 is one of the environmental papers. Related to the S and related to the G, we have 3 papers. Related to the S, we have 3 papers with disclosure requirements with regard to social behavior, and G is the governance. And all the 13 papers were adopted by the EU Parliament, and across all the papers we have 84 new disclosure requirements, and all the disclosure requirements are linked to 1,144 new KPIs. And you as a customer are forced to report against these new KPIs and against these 84 disclosure requirements. And at this point in my presentation, I really would like to give you a glimpse, give you an idea what is behind the disclosure requirement and what a KPI really means. So on the left-hand side now, you see the disclosure requirement E1-5. This is one out of the 84 requirements. Here, the requirement climate change, energy consumption and mix. This is what you have to report from 2025 on. In order to give you an idea what is behind a KPI, I show you now what we did to help you as a customer to be able to report KPIs. A quantitative report behind this disclosure requirement needs 2 categories of data. First, we have to create for you as a customer a greenhouse gas emission inventory. And secondly, we have to bring ESG descriptive data out of our S4 system in order to mix environmental data, greenhouse gas emission data, to mix them up with transactional data in order to derive the KPI. And in the disclosure requirement on the left-hand side, we can first identify the emission data. You can see that under A, B, C, D, E, full consumption from coal, full consumption from crude oil. These are a new type of data. You have to collect this data, and we as SAP or a software provider must fulfill the requirement is software to manage all the data from a digital perspective. So typically raw data to be collected to derive the emissions, and here we have to derive this, we have to identify the source data for that. The second type of data here that we can identify as SAP are the emission purpose. So for what purpose are the emissions used? These are informations, we get this information out of our S4 system. So let me make an example. 37A means total energy consumption from fossil sources. This is an aggregation based on the data type, the emission data type, and mixed up with transactional data that are coming out of the core system. So this is what we have to do. We have to establish and derive a greenhouse gas emission inventory, a customer-specific greenhouse gas emission inventory. Third, we have to identify more transactional data because the KPI requires that you divide your emissions if these emissions are caused by your own operations or if these emissions are caused by your suppliers. So we have to identify, again, transactional data to make this KPI real, to make this KPI happen, to be able to derive this KPI. So this type of data are relevant for the identification where these data are caused in your business processes. And the fourth data type are finance data, because you have to mix up this KPI with finance data, total energy consumption in megawatt hour per net revenue in euro. So we need, again, metric data, measurement unit, and accounting data. These 4 types of data we have to collect, and we have to picture them in a software system in order to derive a KPI. The KPI here is the KPI E1-5. And as I mentioned already, E1-5, this KPI is a data mix between greenhouse gas emission inventory data and ESG descriptive data. And as I mentioned before, 1,144 KPIs are needed to be reported based on the ESRS requirements. Three sentences are worth to mention here. So the KPI characteristics, the core of all ESRS KPIs is that all disclosure obligations within the ESRS require the emissions to be placed in a business context. As I presented here to you, the business context here is own operation and net revenue in euro. The second sentence that is worth to mention here is the meaning for software design. So the context to be established requires the orchestration of well-known transactional data, for example, finance data and finance data, to mix this data up with the newly derived emission data. And the last sentence here, the top challenge we observe in our daily business is the data sourcing with reference to the emissions to be collected. Where does the data required for the e-inventory come from? I will show you an example later on. So let me make here an example for you, the different meanings of ESG and what is behind a specific KPI. Let us assume that a company contains on 5 legal entities: a legal entity in Munich, a legal entity in Berlin, a legal entity in Spain, a legal entity in Japan, and a legal entity in China. The first step which a customer has to do is to identify all relevant greenhouse gas sources, and he must decide for how this data can be measured or collected per legal entity. And this is a decision. This is a customer has to find a solution for that without considering software. First, he has to make himself aware how he can collect this data based on the specific situation in his legal entity. Again, first step, identify all relevant greenhouse gas sources per legal entity and make yourself clear how this data can be measured or collected per legal entity. Either you can measure them or you have to collect source data in order to derive the emission data based on the source data. This is step 1. Step 2 is then aggregate according to the requirements that are described in the Greenhouse Gas Protocol, because the Greenhouse Gas Protocol is part of the ESRS standards, and take into account the associated financial data. So in this picture you can see that you have to identify the net revenue in order to mix this net revenue up later on with the emission data per legal entity. So this is step 2. And step 3, last but not least, step 3 means now you have to calculate the required KPIs based on the formula that are described in the Greenhouse Gas Protocol. And as I mentioned, the Greenhouse Gas Protocol is part of the ESRS regulation. In this case, by the end of the day, you have 3 E1-5 KPIs, one for Germany, one for Spain, and one for Asia Pacific and Japan. This is the secret behind the ESRS requirement when we talk about quantitative metrics. This is the secret behind the disclosure requirement, and this is the secret behind a quantitative KPI that belongs to the disclosure requirement. And very important sentence here, the presented process lays the foundation for the IT design to meet the ESRS requirements. So please keep that in mind when I explain later on how we decided to design our sustainability control tower in order to meet these requirements. So, but now let me come back why sustainable finance is so important in the ESG discussion. It's pretty easy. Financing and investment are the two sides of the same coin. Please look at that picture here. On the left-hand side, you can see the financial service industry, and they want to do a finance investment. On the right-hand side, you can see the real economy. They need money for real asset investments. And in the middle between is money. And as I mentioned, financing and investment are the two sides of the same coin. And sustainable finance is so important because environmental disasters cost the FSI industry more than $500 billion annually, and therefore governments worldwide are strengthening capital markets resilience to ESG factors. The picture here shows what we can observe at present in the US, in Los Angeles. We have fires, horrible fires, a lot of financial damage. 10 people died so far, and I heard yesterday that already now 150 billion US dollars and damage is caused by this fire. So this is a real problem for the financial service industry. This is a real and huge problem for insurance companies. And that's the reason why sustainable finance is so important, because behind sustainable finance is the idea to transform the portfolios of banks and insurance companies. And the mechanism works, as you can see here. The real economy want to buy a green asset. A green asset can be a physical green asset or a service. So a green asset as a service is you want to buy renewable energy. And for that you have a green finance need to become sustainable. This is the one side of the coin, and the other side of the coin is now that the financial service industry is more than happy to provide now a green loan, a green finance offer to rebuild his portfolio, to make his financial portfolio resilient in order to reduce the brown credits, the brown loans, and to increase the green loans. This is the mechanism behind, and this mechanism is, in other words, sustainable financing as a consequence of sustainable finance. In Europe, we see a lot of initiatives that are supposed to support this transformation mechanism. The first initiative that is worth to mention here is the Europe's Green Deal. The EU invests over 1 trillion euros to support sustainable businesses and climate neutral economy based on money that will be provided in the next years via the financial service sector. The second initiative here is the Action Plan on Sustainable Finance. EU's new fiscal policy was adopted in 2020, and the core of this fiscal policy is the idea to redirect private and public money towards sustainable real investments via the EU taxonomy framework. So the taxonomy framework requires you to divide your activities in green activities and brown activities, and your green activities will be supported by cheap money that you get from your bank. So sooner or later, if you ask your bank or your insurance company for money or a new policy, you can be sure that the bank manager or the insurance manager will ask you, I will give you cheaper rates, a better policy, when you convince me that you are investing in taxonomy compliant activities. Third, worth to mention here is the European Single Access Point. This is of interest for us as SAP because latest in 2030, all the ESG information that are required based on the ESRS and the EU taxonomy must be published on a digital platform. And this digital platform is the European Single Access Point. The idea behind this digital platform is that from there on, all the financial service providers are able to identify in real time the ESG rate of a corporate customer in order to provide them with cheap money in order to rebuild their financial portfolios. So this brings me to my last box here, and this is from my point of view, the most important topic in the ESG debate. Sustainable finance, which is ESG reporting, is a prerequisite for sustainable financing, because a financial service provider can give then money when he is able to see the ratio of a customer, how ESG compliant a customer really is. And ESG compliance, to show ESG compliance, a capability to do so is sustainable finance. And the redirection of private and public funds serves as a tool for governments to incentivize sustainable behavior and to make their capital markets resilient. This slide is a very nice slide from my point of view because it shows where else in the world sustainable finance frameworks and taxonomies are already in place or will be in place on short notice. You see 25 taxonomies are already in place or will be in place on short notice, and in particular Asia Pacific is very interested in the rebuilding of their capital markets and placed very strong taxonomies that divide in ESG compliant behavior and not ESG compliant behavior. Check where you are acting, in which markets you are acting, because you will be confronted sooner or later also with the located taxonomies if you make business in these regions of the world. So it is important to make yourself ready for reporting, because a lot of taxonomies are in place and you can benefit from ESG compliant behavior. This brings me to the summary of my first chapter. I will start my summary with a sentence. So I hope that I was able to explain you that ESG is a complex concept that must always be understood within the context of current political developments and different speeds in the world. As SAP, we must address all three dimensions, so the voluntarily, the intervention in business processes, and most important, the ESG reporting. And from that, three core statements can be derived. What we can observe at present is a shift in focus. In the light of increasing environmental disasters and resource scarcity, the focus is shifting from social aspects, the S, to ecological priorities, the E, and from direct intervention in business processes to standardized and mandatory ESG reporting, which is sustainable finance. And this is what we can observe from a global perspective. Topics like the combustion ban or the Lieferketten-Sorgfaltspflichtengesetz, the CF3D. There is more focus on other topics. There's more focus on ESG reporting, on ESRS, and it is lower focus on CBAM or regularities like that. The second topic, sustainable finance. This is what I have explained in detail based on the KPIs. ESG compliance, especially the E, is becoming a differentiating investment criterion in the capital market, as the E has a significant influence on the value of a company and is therefore of interest to financial investors. ESG reporting capabilities, in other words, sustainable finance capabilities, will therefore definitely become an economic advantage. And sustainable financing, and this sentence is really important for me. We will see what will happen. On short notice, President Trump will take over again the role of U.S. president, but and his target is clear: drill. But from my perspective, changing political conditions do not change the principle of sustainable financing, as financial investments and open capital markets follow their own rules. And as I have presented and explained, banks have a significant risk in their portfolios if they are invested in brown technologies. And as long as we have free capital markets, also President Trump can't roll back the transformation that happens in the past, that the financial service industry is interested in becoming more green because they must reduce the risk in their portfolios. So my sentence here is, as the financial service industry is forced to restructure its finance and insurance portfolios from brown to green, capital in global financial markets is continually flowing towards the best performing e-assets. I'm convinced that this is the case and this will be the case, and also President Trump can't stop this transformation rule. So this brings me to my second chapter, the SAP solution concept, our modular structure for ESG end-to-end. In this chapter, I will explain how we at SAP have organized our software development lines to address all the ESG dimensions I just outlined, and what value does each of our solution line delivers, and how the solution lines fits together to provide an end-to-end experience on ESG, and why we as SAP decided to meet ESG requirements based on our modular strategy. So let me start with this picture here. This picture was handed over to me by our SAP Chief Sustainability Development Owner, so he is responsible for our entire sustainability product line, and we deliver ESG based on, let's say, 6 solution lines, 6 development lines. I will go now in detail for each solution here. So the first solution is the first honeycomb here is the SAP Green Token. This solution is based on blockchain technology and addresses all the ESG requirements that require traceability. A green token is therefore intended, for example, for the German Supply Chain Due Diligence Act or the CBAM or the EUDR, for example, because there you have the need to trace supply chains. Another development line is the SAP Responsible Design and Production development line. This line of development refers to requirements of circularity, the European Product Pass, for example, and thus the packaging and packaging waste regulation, or the Eco Design for Sustainable Product Regulation, the so-called ESPR. Circularity. So SAP Responsible Design and Production is our product line for all that is coming with the requirement circularity. And this brings me to the next product line, SAP Sustainability Data Exchange. This is a product line that ensures that ESG data, in particular CO2 emissions, can be passed on along the supply chain. As a medium-sized company, for example, in the automotive industry, you are asked by large manufacturers to report your CO2 emissions associated with your products. SAP Data Exchange supports this information distribution along the individual supply chains. SAP Data Exchange also enables integration of external data providers that deliver average values for CO2 emissions. So this solution is needed to help our customers in their decarbonization strategy and is also supporting data for sustainable finance. The next solution is that I would like to present to you is SAP Sustainability Footprint Management. This is a solution that enables you to measure your product footprint based on your business processes. You can measure with the solution your product footprint as well as your corporate footprint. Solution is intended to support a customer's decarbonization strategy, and the solution is also intended to support data for sustainable finance for the ESRS reporting. Then here is a pretty new product, our SAP Clean Ledger. The product entered the market in December 2024 and treats CO2 emissions in the same way as the postings in financial accounting. This means that the CO2 issues are posted in the same way as FI postings along the chart of accounts you know. The Green Ledger is ideally positioned, similar to the SAP Sustainability Footprint Management, to support a customer's decarbonization strategy, and all the values that are reported there can also be transferred then to the ESG reporting. So the Green Ledger is more or less also a data provider for ESRS reporting. Finally, I would like to introduce you to this SAP Sustainability Control Tower. From my perspective, from my point of view, the heart of our SAP ESG strategy, because the Sustainability Control Tower is SAP's central tool for measuring ESG in the broadest sense. So this tool integrates all the data out of the other honeycombs and integrates also data out of our core systems to be able to measure ESG compliance. And as I mentioned at the very beginning, measurement of ESG compliance means voluntarily decarbonization strategies, voluntarily reporting, following voluntary standards like GRI standard, SASB standard. But for me, really important, with this tool, we also deliver all capabilities to be in line and compliant with the ESRS, with the taxonomy, with the US SAC, with the ISSB standard at present and what is coming in the next months and years. This is our central tool for ESG reporting. Last but not least, it's really worth to mention that we have many partners that help you to close niches in local markets. So as I presented at the beginning, we have different ESG regulations worldwide, and you will find a partner which is able to support you in a specific place in the world with a specific regulation. So we have a lot of partners that are creating their own solutions based on our technology, and also these solutions are fully integrated with our SAP standard solutions that are pictured here as honeycombs. So this brings me to the summary of my second chapter, Modular Structure for ESG End-to-End. I'm start with a key sentence. Since ESG is a global issue influenced by political decisions, there can't be an out-of-the-box or one-size-fits-all for all the time solution. Instead, and I can confirm you that this sentence is really delivers the right message. Instead, ESG requires a long-term sustainable IT concept that adapts to evolving requirements and best practices. Again, 3 key insights related to the usage of standard software can be identified. First, think ESG globally. We as SAP must think ESG globally. You as a customer should do the same. If you are acting outside of Germany, outside of Europe. Since global companies rely on exports and imports, I'm pretty sure that all of you have also to consider ESG regulation that are relevant outside of Europe. So since global companies rely on export and import, software must not only think locally, but also must be able to map the standards and data that apply outside of Europe. And we as SAP have to integrate all the data, the source data, the derived data, as you name it, into your own company's own reporting. We have to consider that, so we have to think ESG globally. Second, investment protection. I explained that ESG has different speeds, so software must therefore have a modular structure to address both the global dynamics on the one hand side and the diverse business models of our customers. Let me make an example. A company that is operating in few markets with a uniform business model will for sure need a different ESG software architecture than a company that is operating in multiple decentralized markets with a diverse product portfolio. So the business model determines how complex or how easy your ESG IT architecture at the end is. And from my perspective, regarding sustainable finance, if you are a mid-sized company, my educated guess tells me that the control tower is a pretty nice starting point for ESG in terms of sustainable finance, and around the SCT, maybe the architecture will grow in upcoming years when you understand ESG requirements better and better, and when the regulation is more clear, especially also outside of Europe. Last sentence here, also very important, usability. ESG has to be fun. At present, ESG is a headache, a really headache and pain in the neck. But ESG has to be fun. This means ESG must be integrated into the DNA of every business processes. So this is our target at SAP. The reason is we need a positive cost-benefit ratio for ESG reporting, and this means we have to care therefore that ESG is not a pain in the neck and must be a daily process. And in the next future we will likely see some changes. On the one hand side, we see that regulators are simplifying rules. There is this great movement in Europe to harmonize rules. On the other hand, we see that the auditors offering more and more better guidance to their clients, and we as SAP working to make ESG reporting easier based on technology, and for course and really important based on the capabilities of artificial intelligence. This brings me to my last chapter, the solution concept of the sustainability control tower. I will do that illustrative, so I have no system presentation with me. We can do that next time for sure, but today I present you the key architectural design principles we implemented in our control tower design. I will explain in this chapter how we at SAP have designed the SCT to meet all ESG reporting requirements, coming from voluntary reporting and ending with sustainable finance. What value does this design delivers to you as a customer, and why I recommend starting the ESG journey without focusing first on searching for IT software solutions. So let me start with the 6 key architectural design principles to meet ESG in the sense I've presented to you in chapter 1. The first really important capabilities we deliver is a very strong and high performance data model. When I presented and explained to you the derivation of a KPI, you can imagine that it is really complex to derive all the KPIs, the current KPIs, upcoming KPIs, and so we decided as SAP to implement and to deliver a high performance data model which enables a customer to create all the emission inventories that are needed and to bring all the ESG descriptive data into this data model. This is the first key architectural principle. We have a really high performance data model implemented in the control tower, flexible and strong and powerful. Second capability here is ESG tooling. We need to deliver tools that are growing with best practices and that are growing with the legal requirements. We need tools to deliver a better user experience. We need tools to define flexible workflows, flexible specific workflows to meet all the ESG process requirements. The third topic is really important. We need a strong calculation engine. I presented to you how complex it can be to derive a KPI. Therefore, you need really a very flexible and modular calculation engine. And we deliver, this is the fourth point, all ESG reporting templates. When we learn how KPI must be created, we take this as a template in our solution and we deliver the KPIs then as sample content to our customers. We do this for the taxonomy as well as for all the ESRS disclosure requirements and KPIs. And last but not least, and AI capabilities are very important to support the derivation of KPIs and to support also the creation of the disclosure requirements. The third key architectural principle is keep the core clean. Transactional emission data are source data for ESG reporting. No one should try to incorporate ESG information in the core system. By the end of the day, you will lose your SAP standard compatibility, because I hope that I was able to make clear that ESG is so dynamic, you will fail if you try to incorporate that directly in your core systems. Keep the core clean and take the core systems as a data provider for sustainability issues and topics. And this point is worth to mention that you have to consider from now on external emission data. This is what I presented to, what solution we have for that. And we have also considered that we can work with non-SAP data, because ESG is broader than sometimes the SAP architecture on our customer side. So we've also considered non-SAP data. This brings me to the fourth architectural design principle. Again, keep the core clean. We need to deliver an interface architecture and data integration layer in order, and this is really important, in order to automate the data upload from the source systems into the control tower. I have presented to you, when I presented the KPIs, that data sourcing is the most important topic, and we as SAP try to automate the data sourcing stepwise from a manual way into an automated way, so that from now on in the annual reporting, the source data are transported automatically into the control tower. This is the fourth key architectural design principle. The fifth key architectural design principle is a very interesting one. The reuse of already known SAP standard functionality. Especially the auditors really like that we reuse in the control tower our authorization role management concept, our workflow management concept, our audit trail and traceability concept. This is really important to make all the ESG data audit compliant, which is required from this year on that you deliver audit compliant ESG reports to your auditor. Planning, reporting, and forecasting capabilities are as well part of the control tower. At the artificial intelligence, I mentioned that already. And last but not least, we interface our SAP Sustainability Control Tower to external data providers for all consolidation aspects and for planning and analytics outside of the control tower from the perspective of an entire group, for example. So the control tower contains all the ESG reporting templates and can be used for all the legal reporting requirements. But at the end of the day, you have to consider to transfer the data to external systems for group reporting, for example. And for that, it is also decoupled based on an interface that you can also provide this data to external consolidation systems. Could be SAP's disclosure management or could be also partner solutions. So this brings me to my last summary regarding Sustainability Control Tower. Again, a key sentence: in a dynamically developing uncertain world around ESG reporting is the top priority in terms of costs for IT, investment protection and software. The first point is to ensure investment protection, keep the core clean. Please follow this rule. Legal ESG reporting or sustainable finance is primarily a reporting task and should be managed outside of a customer's core system. Second, keep ESG simple. So reuse standard functionalities as much as possible. We did that because already known SAP functionalities is a key deliverable to all of our customers. Single point of truth, very important with regard to ESG data outside the core. The Sustainability Control Tower is nothing else than an ESG data representation of your entire company, and tools that grow with legal requirements and customer best practices. So we deliver technology, best practice and templates and tools in the way we better understand what a customer needs and we better understand what is really behind a legal requirement. So it is not that a software provider can say, we are ready, this is the solution, and you are ready for all the time. This is not the case. You need tools that grow with all the learnings we are doing at present. And last but not least, this is also what I mentioned already, AI and ESG. AI is uniquely suited for ESG reporting and will significantly simplify compliance with reporting obligations in the near future. We are working at present on very, very interesting AI use cases for double materiality analysis, for eligibility, taxonomy screening, for greenhouse gas determination. And I'm really happy when I see what is the outcome of the pilots. And from my point of view, we will see in the upcoming months that ESG can make fun if AI is on the right place in the process. This really brings me to my really last slide. I would like to give you a recommendation how you as a company or a corporate customer should start your ESG journey. I presented in my chapter 1 the different meanings of ESG. So the different meanings of the ESG is missing here, but the different meanings of, and then ESG. This is what I presented in my chapter 1. Chapter 2, I presented the SAP ESG solution concept. In chapter 3, I presented ESG reporting, the control tower. And my recommendation to move on with ESG means first, as I explained, ESG requirements are diverse and individual. So they should be defined in a collaboration with the auditor and then incorporated into a comprehensive company-wide ESG roadmap. So start your ESG discussion without considering IT. Make you aware what is really important and when is what really important in terms of ESG. In a second step then, identify and decide which IT capability is needed at what point in time. And this is the reason why we decided for a modular strategy. Maybe you identify that you can start with the control tower or you can start with the other solution. But the second step that is following by the first step, ESG definition requirement, should then be to decide for the IT roadmap that fits to your ESG roadmap. And then you can create your IT ESG roadmap and you will do the right things from a short, medium and long-term perspective. And this saves money. This ensures investment protection. And last but not least, as I already mentioned, our experience with customers and auditors show that ESRS and taxonomy requirements can be really effectively mapped in the SCT once the agreement has been reached with the auditor. Once you know which disclosure requirement is relevant for you and your company and which KPI is needed, then it is pretty easy to picture this requirement, this KPI in our solution. And compared to Excel-based reporting, this approach is significantly easier than to do it based on Excel sheets, because in the first year, there is effort to bring this in a standard software solution, but from then on, in the second year, in the third year, in your annual reporting process, all the things are highly automated and you can benefit from the usage of standard software. And as I mentioned, our experience shows the SAT is a pretty nice solution to start the ESG roadmap. My personal recommendation, keep it simple. Sometimes it's better to continue using Excel temporarily, make you aware by your ESG roadmap, rather than investing in the wrong IT solution. And EU taxonomy, the materiality assessment, and building a greenhouse gas inventory are really excellent starting points for discussion with your auditor, and then for starting your discussion with your SAP counterpart. Thank you very much for your attention, and now back to you, Larissa, for questions.